You're actually, when you look at the S&P 500, are you looking to short it?
Yeah, we are short the S&P 500. We've only done that in the last couple of weeks.
But the problem started long before Trump was elected. You know, he called this a big, fat, ugly bubble when he was running.
But he's the
and
one
he was
now.
right.
Today, sit down, put your ear muffles on, because today we're asking the age-old question: is the stock market going to crash? Let's jump right into this. Welcome back, my passive income investors alike. In this video, we're going to take a look out into the horizon to see if a stock market crash is coming and if we're headed into a recession. Now, I'm also going to show you how you can best prepare yourself to be in a situation where you don't even really have to care, to be honest. But let's start by getting the boring stuff out of the way, because I'm sure you've all heard about them inverted yield curves.
The yield curve. Explain to the dozens of listeners what's happening today.
Sure. So we saw today that the yield curve on the 5-year Treasury note fell below the 3-year note. Strange, if ever, when it happens that a 3-year note has a higher yield than a 5-year note.
How about them tariffs?
It's war, but not with tanks and guns. This time, tariffs and Twitter feeds, the ammunition in the latest escalation of a bitter trade dispute between the US and China.
I want to show you something to help open up your Western mindset, expand your consciousness. So we're going to take a look at some charts. I want to show you them first. Just take a peek at these and see if you recognize any of them. They all probably look pretty obscure and things you're not used to looking at, except for this one, because this one is obviously the S&P 500, which represents the 500 largest companies in the US. And I'm sure you've heard that the US has been on an expansion never before seen in stock market history. In fact, if you put money in the markets anytime within pretty much the last decade, you have made a substantial amount of money, even within the last few years alone. But the other indexes and all these other charts represent, well, take a look, Shanghai index, the European index, even the Canadian index hasn't had the growth rate that we've seen in the US. And literally, this is the first time in such a long period of time that we haven't seen a solid crash or recession in between, which is getting people very on edge. And you'll see a lot of people pushing toward what are called safe haven investments. Usually consumer non-cyclical stocks, as they are called, and what those kind of represent are your basic Procter & Gamble, your Johnson & Johnsons of the world, because it doesn't really matter if a recession comes, even though Johnson & Johnson is not up, but Procter & Gamble is on fire. Usually these kind of companies do really well in recessionary type periods, and when people get fearful, because you're still going to need toothpaste, you're still going to need basic medical needs like you get from Johnson & Johnson. So these are companies that we would usually define as recession kind of stocks. So people tend to flock toward them when we start looking out on the cusp of a crash or a recession. There's one place you can definitely look is gold. Now, many of you know that I'm not the most fondest investor into gold. I actually sold off almost all of my precious metals at the beginning of the year. Not all of them, actually. Speaking of some silver and gold here, I actually kept some of my silver and gold coins. If you want to take a look, I have my cool little, now that Halloween's coming, I don't know if you can see that, but that's in a zombie apocalypse kind of silver coin. I really hope it's picking it up because it looks really, really cool. But I'm not a fan of gold or silver because it's usually where people will flock in light of fear. But if you are a long-term investor, and you probably watched Warren Buffett speak, I mean...
And buying something because they think it's going to go up next week or next month, and for whatever reason people give you, you should understand what you buy. Now, if you buy a farm, you look at the farm and you say, I expect to get so many bushels per acre of corn or soybeans, and you figure out how much that'll be worth, and then you figure out what the price should be. In stocks, people, their neighbor whispers something to them, and they run out and spend money that it took them years to earn. So you always want to look at the productive ability of the asset you're buying.
Gold is not an investment at all. Gold, to go back to where we started, Poppy, is a speculation.
I don't want to own gold because it has no yield, but I use it to reduce the volatility of my overall net worth, and it works. But frankly, I think gold will be dead this year.
So gold's been on a bit of a run if you've owned it, but over the long term, guys, over the long term, the rate of return in gold has just been above inflation, about 2% a year on average. So it's not that great considering it doesn't produce cash flow month over month like real estate does or like stocks and businesses do. But when recessions come, guys, people get really paranoid. And when we're trying to look out to see what predicts and what causes a recession, it's almost impossible. So if we look back through history, ladies and gentlemen, we can find that in other stock market crashes, not only did hardly anybody predict them in the first place, minus a few that we've made movies out of, but we're talking like we've had a major housing crash. Before that, we had a tech bubble. And usually every 8 to 10 years, we do see some form of a recession or a crash in the stock market. But things, my friends, things have changed. We live in an extremely unusual time within the markets. This is the first time when we can pretty much finance everything we own. Kids are all living at home into their 30s. Money seems to be endlessly getting printed. Interest rates are going down, which is another sign of a recession coming, because, I mean, they only do that if they don't want to bug the market out, because if there's more cheap money out there, the more people are going to be buying and selling and trading and keeping the economy flowing. Now, I'm not going to get into the complexities of the economy because we could talk about a credit cycle that usually happens, which we haven't seen at all yet. And I honestly think that might be one of the greatest indicators of any kind of market recession, because when debt has taken out, you owe something from the past into the present. And at some point, you have to cut back on expenses and spending to pay that debt back. And we can see this coming with student loans. In fact, they're predicting a stock, or not a stock market, but a crash in auto loans because people have been financing their way into the ground. If you've ever heard of the term negative equity, there are like thousands, tens, hundreds of thousands of people that are probably negative equity on their brand new cars because the cars you lose value faster than they can pay them off. If you honestly want to see when a market crash is going to come and what I think are going to be the greatest indicators, hands down, that we're going to see that's going to cause a stock market crash, aside from all of the individual loans people are taking out, the crazy amount of credit card debt and all of that, the thing you're going to notice is when people stop renting properties. When the renter market slows down, if that doesn't continue to increase, that's when you're going to see a big market crash. I'm sure you've noticed in certain parts of the US, especially here in Canada, near any major city, there is a crazy amount of condos, there's a crazy amount of construction going on, and it's just this imploding, this impluming, wonderful economy expansion happening pretty much all over the Western world, in the US and Canada. And the day that stops is the day you're going to start noticing bad things are coming around the corner. Look at your own backyard. The day those constructors stop building homes, and the day people stop going out and renting new places, and in fact not even being able to afford their rent, that is when all of a sudden people are going to start defaulting on their mortgages. That's when you're going to start seeing people not paying back their credit cards or their loans. I feel like we are on a very slim edge right now. We're walking the tightrope, and it's a lot of people out there, but it's such a hard thing to gauge because of cheap money, guys. The thing, in my personal prediction, the stock market has tending, this line doesn't really represent any of it because the S&P has done something like this in the last couple years. So this is kind of what the S&P 100 looks like. We've been following this trend over the last couple years. We had a little bit of a dip, and we're still heading in the upwards direction. And a lot of people are saying if we can't continue this trend right now, we are at a very crucial point where the markets could take a bit of a dip. But here's my thing. What people don't realize is even though there's massive debt out there, companies are larger than they have ever been. Companies have been making more money than they have ever been. If you went back 10 years ago, right after the 2008 Great Market Recession, and told somebody that a company would be making $40, $50 billion a quarter, like, they would laugh. They'd be like, yeah, right, okay. Today that exists. Most people don't realize how fast the companies have been expanding. It's honestly staggering, and it has to do with what was called quantitative easing. A lot of people forget that happened. And what is quantitative? I'm not even saying it right. Quantitative easing is when, after 2008, to prevent a serious depression, the government printed off trillions of dollars and flooded into the market. Now, that seemed like a bad idea at the time, but now that we're looking at companies that are worth like over $1 trillion, that changes the outlook of the economy immensely. The problem now is we have all of this money flowing out of the market. We have all of this debt flowing out of the market. And what ends up happening here is even if the stock market does crash, The crash doesn't mean the money just disappears in thin air. It just means people are pulling it out of the market. And they still have to do something with that capital. And if there's one thing I know, especially about today, people are antsy. People can't sit still. And that money can flow in almost just as fast as it flows out, which we saw in 2018 when we saw this first market dip in the S&P 500. And I had a small prediction where I thought the market was going to trend sideways. I honestly think we're going to see, it's more likely in my opinion that we're going to see some more volatility in the market, and we're going to see a trending sideways. And the only reason I'm saying that is because there's so much money out there. There is so much money flowing into these countries right now that the only thing keeping it up isn't me and you. The real estate market isn't kept up by me and you, because obviously, especially if you live in the Toronto, Canada area here, I ain't the one driving the prices up to $1 million plus. That ain't me, and it's probably not you. So somebody has to be doing that. So where is that money coming from? And it's the same thing with the indexes. In fact, there's so much dumb money in the markets. And well, what's dumb money? People that put money in S&P 500 indexes. Now, whether the markets are going to do good or bad, people that don't know what they're doing, which is the majority of people, and everybody, including myself, has bought in index funds. And we buy them because we know over a 20-year time period, they've never lost money. So when everybody's doing that and not paying attention to the fear of the market, even if the economy is not doing well and everyone keeps their money in those ETFs, nothing really happens. Like, the market continues to trend sideways. Or we get these really volatile moments that I think are caused not only by day traders, by robots, algorithms trading. And trying to keep up with it is so hard to understand because you're competing with dumb money, corporate money, and day trading money. And between all three of those, especially with a company like Apple, I'm sure you've heard of something called share buybacks. When Apple is buying back their shares, literally every dip they come down, they end up flying back at some point because Apple just says, forget it, we're just going to keep buying our shares off the market. So when a company has hundreds of billions of dollars, they're doing that. You got all the dumb money flowing into these safe investments that continues to add to all of those companies. We start seeing a trend. And that trend to me is going to be sideways. I think the day traders, swing traders, and all the people that have fear are going to continue the volatility in the market. But for as long as that cheap money keeps flowing, for as long as people keep having jobs and they ain't missing those rent payments, because we've all heard the statistic that I think it's like 50%, more than 50%, I think it's something like that, of the entire country, if they had to fix their car and come up with $1,200 like tomorrow, they'd have to put it on a credit card, because most people don't have investments. Most people don't have an emergency fund or savings, which is why I hope you come to this channel, because I show you my 6-figure dividend stock portfolio. And by the way, if you enjoy that, consider slapping a like and subscribing. We are so close to growing over 1,000 subscribers in less than a year, and I can't say thanks enough to you guys for sticking around. But coming back to this, guys, if you want to be able to survive a stock market crash, well, what are my personal recommendations? Well, I don't buy gold. I don't really own real estate, because real estate can be really troublesome in a crash as well, especially if you're owning like apartment buildings. You need to be in a very good niche, or maybe like family housing with good rental or good renters to try and generate rental income, so if that property drops, you're still getting that cash flow. And that's the thing that I'm going to mention the most here, is you're looking for companies that will cash flow, and you're looking for a way to sustain income during a crash. So what does that all mean? Well, my philosophy behind a stock market crash is the only people that lose are people that jump off the roller coaster during the ride. This is a long-term game, people. We're doing this for 20, 30, generationally, okay? So we want to be able to ride this out with the least amount of bankruptcies as possible. That's always the main goal here. So we're looking at companies like consumer non-cyclical stocks. We're looking at companies that are recession-proof, that have survived recession after recession, that can sustain the long-term periods. Now, for me personally, I really enjoy sin stocks lately. I've talked about this immensely. They're extremely undervalued in my opinion, and these are companies that actually do well. Their balance sheets do excessively well in bad times because people take up bad habits when they have nothing to do to help deal with the stress. Not saying that's a good thing, but they tend to do well. And the same with those stocks like Procter & Gamble that produce toothpaste and basic necessities like toilet paper when you need it, diapers, things that you can't really live without even if some bad times fall upon us. Now, you're probably thinking to yourself, well, what if it's the end of the world? What if it's doomsday? What do we do? Well, you're not going to worry about the money anyways. You know what? If you buy the right banks, there's obviously, if you buy banks, some of them can go bankrupt. It's happened in the past, but you want to stick to those big banks with the term too big to fail. And what do I mean by that? Well, too big to fail means these companies are so large that the government won't allow them to fail. In Canada and in the US now, most of the banks are backed by the Canadian Treasury, or I imagine the Federal Reserve in the US. And the reason they do this is to protect your money from the bank going bankrupt. So when your money's in your bank account, sitting there, it's rotting from inflation, but if it's invested, guys, you're protected with that money within that account. So if that bank goes bankrupt, the government's still going to get you your money back, which obviously there's no guarantees, because the real saying my mom always tells me, that if you buy bank stocks and the banks go bankrupt, the money in your pocket is just as worthless. And you won't be worrying about money, you'll be more concerned about what Warren Buffett said about owning farms and producing food. And let's hope that doesn't happen, because if it does, trust me, the last thing you're going to be paying attention to is the stock market. So in light of that, guys, let's hope that doomsday is not coming, a black swan event is not approaching, and that we're going to see maybe a recession or a slowdown into the future. And my personal prediction remains the same. The stock market's more than likely going to trend sideways. You should be buying and holding safe stocks along with growth stocks that pay really healthy dividends with some growth. There is nothing wrong with owning growth, because we cannot predict a crash. So you want to have a good diversification, mainly in stocks that pay monthly or quarterly dividends that are sustainable, because that'll give you cash flow. So into the future, if the markets crash, you still have an income coming in to buy back some of these companies, because we still want to be buying them in a recession. That's when we're going to get the best discounts. So that is what you have to kind of emotionally prepare yourself for. And the reason you still want a little growth is if the market doesn't go the other way, some of these companies are still going to do incredibly well. We're talking companies like Apple that don't pay as high of a dividend yield, but still sustain very well even in bad times. So that way your portfolio might see some growth, but if the economy goes the other way and those stocks come down, you still have your very stable, your Johnson & Johnsons of the world, those companies you know that are going to be around no matter what, because they are just a fundamental part of nature and reality. On that note, guys, I want you to let me know what you think in the comments section below. I'm going to finish it up there. This was a fun rant, so stay cool, stay awesome, guys. I look forward to chatting to you real soon.